Okay, shall we get to work on this? We're going to work these in numerical order. I think this is number 3 on chapter 2 is first up to bat on the practice. Let's see, preview. I should show you the list of who's actually done it so you guys could feel ashamed for those of you who have not done anything. Okay, here we go. Klingon cruisers purchased new cloaking machinery 4 years ago for $4 million. The machinery can be sold to the Romulans today for $3.6 million. Klingon's current balance sheet shows net fixed assets of $2 million, current liabilities of $700,000, net working capital of $216,000. If all the current accounts were liquidated today, the company would receive $1.03 million in cash. Okay, let's talk about what that last thing means. If they're liquidated today, they would receive $1.03 million in cash. So in other words, if they liquidated all the current assets, paid off all the current liabilities, this what they would get this left over. And so that in actuality is the market value of your net working capital. Go ahead and mark that. That's the market value of your net working capital. By the way, are my numbers slightly different than yours?
Yes.
Yeah, these are algorithmic. They're different for everybody, so you guys just don't say, oh yeah, I got that from Frank, right? Okay, so what is the book value of their total assets today? Okay, so their current balance sheet shows net fixed assets of $2 million. So we're looking at $2 million, and that's the fixed assets? So, what do I have to find in order to get total assets?
Current.
Yeah, I got to find the current assets. So, let's read back through here and see what they say. Current balance sheet shows net fixed assets, current liabilities of $700,000, and net working capital of $216,000. Which two pieces of information can I use to get current assets?
Liabilities and net working capital.
Yeah, so we've got net working capital and is equal to current assets minus current liabilities. So how can I get current assets? It's just NWC plus CL, right? Does that make sense? Okay, so net working capital on the balance sheet is is $216,000. Current liabilities is $700,000. So I think this thing is $916,000. Does that sound right? Okay, so that means I think that the total assets are $2,916,000. Let's see. Oh, there it is. Damn, I'm good. Oh, by the way, I will screw up before the day is out because I'm human, right? Okay. Do you guys see how that worked?
Can you put the...
Well, I kind of got my dangler there. Pesky new computers. Is that better?
Yeah.
Okay, or you
I just
could...
can't see that part of the board.
Oh, okay. Okay. Does everyone get that? Okay, now they say, what's the sum of the market value of the net working capital and the market value of the fixed assets? Well, we just got through saying that 1.03 million is the market value of the net working capital. And what's the market value of the fixed assets?
3.6 million.
Yeah, 3.6 million, because that's what we could sell it for today. Does that make sense? So what's the sum of the market value and the market value of the fixed assets? So, because they don't mention any other fixed assets, do they?
No.
Okay, so I'm thinking this is 4.63. Is that what it says?
Yeah.
Woohoo! You see how easy that is?
Yeah.
Yeah. Okay, now the next question is number 5. Masters has sales of $46,700, cost of $16,120, depreciation expense of $27,20, interest expense of $15,50. If the tax rate is 23%, what is the operating cash flow? OCF equal EBIT plus depreciation minus taxes. You don't have that on your note sheet? You should. Okay, so we already have depreciation 2720. And what do they say the taxes are? Oh, they don't. They tell us the tax rate. And then they give us some information to figure out EBIT. So they give us sales, 46,700. What should I do with the costs? I guess I've already put it up there. I'm going to subtract out 16,120. And then what else should we subtract out before we calculate EBIT?
Appreciation.
Yeah, the depreciation. And the depreciation we said was 2,720. And so my EBIT is, well, I should probably do that on the calculator, right? Let's see if their number is right. I can see their answer below. 46,700 minus 16,120 minus 2720 equals, so I'm getting 27,860, just as they did. Now, EBIT, something we have to subtract out before we can calculate our taxes. What is it? Yeah, the interest. So we're going to subtract out 1,550, and I believe that is 26,310. Is that correct?
Yeah.
Okay. So, how do I figure the taxes now? Yeah, times 0.23, right? So I'm going to go ahead and do my subtraction here so I'll have the right number in. And then I'm going to multiply by 0.23 equal. So I'm getting 60, 51, 30, is that what you get? Okay. Now, in order that, so if we went ahead and subtracted that out, we would have net income. We don't actually need net income, do we? Do we already have everything we need to know? I think we do, because we've got EBIT, 27,860, plus 2720, minus the taxes of 6051. I have a feeling they're not going to worry about the 30 cents, but here we go. So I'm just going to have plus minus here to make that a negative. I'm going to add 2,876,0 equals plus 2,720 equal. I'm getting 25,429, which is what they get. Okay, now let's talk really quick about conceptually what is operating cash flow. It's cash flows you're getting from operations, so we're only concerned about operations and we're only concerned about cash. The problem is EBIT has depreciation subtracted out of it, so we've got to add that back. But we have to subtract the taxes out because our taxes are real cash flow. Yeah, anyone who's ever paid them knows, right? And so there's one more question here, and that is, why don't we care about interest? Accountants are under the delusion that interest is an operating cash flow. Are they right?
According to you, no.
According to me, no. So that means no, right? Okay. So, and it's not just me. It's the entire canon of finance. Right? Okay. And we are so much sexier than accountants ever dreamed of being. Back to the story. Any questions? Okay. Now we are on to, of course, let's see if I can mark these off and give us a feeling of accomplishment. Now we're on to number 7. Come on, so lazy. Okay, the 2019 balance sheet of Dry Deck Skate Shop shows long-term debt of $3.1 million. Folks, don't make me compete with you, please. Long-term debt of $3.1 million. The 2020 balance sheet showed long-term debt of $3.3 million. The 2020 income statement showed an interest expense of $105,000. What was the firm's cash flow to creditors during 2020? So here's what you need to know about cash flow to creditors. Cash flow to creditors, and you may see it written other ways like CFB and whatnot, is equal to the interest, because after all, aren't we paying interest to our creditors? By the way, creditors are people who loan us money. So we're paying money to them, but we have to subtract out any net new debt that we go out and borrow. And it's long-term debt, always long-term debt, net new long-term debt. Has to be interest-bearing debt. We're not worried about current liabilities here. Okay, so they're telling us how much interest are we paying out to these folks? 105,000, does that sound right? Okay, now minus the net new debt. So what was the debt at the end of the year? 3.3. And what was the debt at the beginning of the year? 3.1. If my math is correct, this is 200,000 bucks. Is that right? So we went out and borrowed 200,000 more. We had 105,000 we paid in interest, so we're actually looking at negative 95,000 bucks. So the cash flow to creditors was negative, means it actually was cash flow from creditors. Does that make sense? Very good. Okay, let's see. 9D. Okay, Schwert Company shows the following information in its 2020 income statement. They give us sales, they give us costs, they give us other expenses, depreciation expenses, interest expense, they give us taxes, dividends. Oh my goodness. In addition, you're told that the firm issued $4,900 in new equity and redeemed $3,400 in outstanding long-term debt. Let's ask this question. What does redeemed mean? If you redeem a debt, what does that mean? Yeah, you pay it off, right? Okay. So let's see. The question I was asked was, if net fixed assets increased by $25,000 during the year, what was your addition to net working capital? Oh my goodness. Okay, so let's see here. How do we go about that?
That's how we feel.
Yeah, exactly. Okay, so let's. Okay, so if net fixed assets increased by $25,000 during the year, what was the addition to net working capital? So let's flip down here, and it's exactly as I thought. Cash flow from assets is equal to cash flow to the bondholders plus the cash flow to the shareholders. And we have another way of coming up with cash flow from assets. Do you remember what it is?
Operating cash flow
Say again.
equal to operating cash flows
Uh-huh.
minus net capital spending
Uh-huh.
minus change in net working capital.
Man, she is on fire. Sweet. Okay, I appreciate that. Okay, so what does that mean? Well, what did they ask us to check for? The change in net working capital. And so I'm going to just do a little bit of math here. And if it freaks you out, let me know and I'll explain it. I'm going to move this thing across the line, and that's going to give us the change in net working capital positive over here, equal OCF minus NCS minus CFA. And we know CFA is actually cash flow to bondholders minus cash flow to shareholders. Does that make sense? Oh, plus, right? Okay, whew. Now I just need to go through and I can distribute that negative sign. You see what I did there? Did I do any magic? Did I violate any laws of mathematics? I don't think that I did. Okay. Now, so what do we need now? We know that if we had operating cash flow, net capital spending, oh wait, do we have net capital spending?
Net capital spending is the increase in net fixed assets.
Very good. Okay, so we already have the, I'm going to go ahead and write that in here, minus $25,000. Does that sound right? Because it went up by 25,000. Okay, now, what about the cash flow to the creditors? We know that's interest minus net new debt. Do we know interest? Don't they tell us? Yeah, 13,400. I'm just going to go ahead and we're going to do a little math right here. 13,400 minus the net new debt. And they say, wait a minute, the net new debt, what did they tell us that they did? Yeah, they redeemed how much? 3,400. So net new debt is actually negative, right? Because we're paying it off. And so what is minus a minus?
Plus.
Plus. And it's what, 3,400? 3,400. And so that's 16,800 if my math is correct. Does that look right?
Yes.
Okay. Now, they also want to know about the cash flow to the shareholders. Cash flow to shareholders, if you haven't already thought about it, dividends are a cash flow to shareholders. Do they tell us how much the dividends are?
10,500.
Ooh, thank you very much. Now, it's really minus net new stock, right? And so we got a couple of things going on here. Not only are we issuing new stock, we can repurchase stock. And so we really have to figure out what's going on here. So let's read through and see. They're telling us sales, costs, other expenses, depreciation, interest, dividends are 10,500, and they issued 4,900 in new equity. So if they're issuing 4,900 in new equity, is that cash flow to shareholders or cash flow from shareholders? From. And so what we're really looking at here is minus, we're going to subtract out that money that we got from the shareholders. Does that make sense? Okay, and how much was it, 4,900? So, if my math is correct, I'm looking at 5,600 there. Is that correct?
Wait, why is it negative?
Okay, so if they issue new shares, so the formula is dividends minus net new debt. The net new debt was how much? They issued 4,900 in new equity, right? And so it's dividends minus the net new debt. And the reason is because that money actually came from the shareholders, didn't go to the shareholders. That's why the formula has a negative sign in it. Good question. Other questions? Now, could someone please tell me if my math is correct?
It's okay.
Thank you.
It's on
Okay.
there.
What's that?
It was C.
It was C?
Yeah. They had you figure out all of those. So you
Oh,
could figure
phew. Damn, I'm good. Okay, so now there's one thing left that I need to figure out. What is it? Operating cash flow. So let's get to work on operating cash flow. What's the formula for operating cash flow? EBIT plus depreciation minus taxes. Very good. Okay, so let's get to work on this. What are the sales?
394,000.
394,000 in sales, and we're going to start subtracting out our costs. 300,000. And they give us something else.
Expenses.
Yeah, other expenses are how much? 7,900. Okay, so we've got the other expenses, and we know we're going to have to subtract out our depreciation. And when I subtract all that stuff out, it's going to give me EBIT. Does that make sense? Okay, so get your calculator out. Let's crunch through that, make sure we got the right number. Say again?
I got
It's EBIT, right?
Yeah.
You got how much?
66,600.
Okay, is anyone else getting that number? Okay, so let's look here. We got 94,000 minus 19,500. So we're looking at 370,500. Does that sound right? Oh yeah, so 74,000. Hell, here we go.
You don't trust me.
No one else is chiming in.
I also got that number.
I'm not doing the math, I'm just writing down the formulas.
Okay, so how much was it?
66,600.
I would trust y'all if more than one of you would say something. Okay, now, in order to figure our taxes, what do we, oh, they tell us our taxes, right? Yeah. Oh man, that's sweet. So now we've got everything we need, right?
Just add depreciation.
Yeah. So 66,600 plus, how much was our depreciation?
19,500.
19,500 and subtract the taxes. How much are taxes? 18,000 what?
600.
620.
Okay. Okay, so can someone do that math and tell me what is OCF?
67,480. We have it.
Yep, okay. Okay, can someone please take 67,480, subtract 25,000, subtract 16,800, and subtract 5,600?
Do we need to add depreciation to the increase in net fixed assets for net capital spending?
Let's see.
Yeah.
Oh, you're right. She is so right. Okay, and why do we need to do that?
The match sheet
That's
budget
what
doesn't
the-
have depreciation.
Yeah, because your balance sheet does not have depreciation. And so we actually have to add back the depreciation that happened during the year. And so how much was that?
19,000.
Yeah, 19,500, sorry about that. And so this number should actually be, what, 44,500? So is it 19,580? Oh. Yeah, I can see that. I was asking about that bit. Okay, so does this math that I have on the board now work out? And thanks for the catch on adding depreciation back to the change in net fixed assets. And the reason we have to do that is because that net fixed asset is artificially depressed by the amount of depreciation. And why do I say artificially? Is depreciation a real cash flow? No. So we got to add it back because that also went away during the year. Okay, and so it actually, yeah.
Is that an A question?
Oh, very definitely. So here's my, and I was going to tell you this. What would my advice be to you if you see this question on the exam? Skip it! Oh my goodness, for crying out loud, just skip it, right? If they ask you for operating cash flow, great. Or better if they ask you about cash flow to creditors, something like that. But if they ask you for that change in net working capital, run, right?
Good strategy.
Oh yeah. Oh hey, life is all about figuring out how score is kept and playing the game accordingly. And it took me like 30 freaking years to figure that out. So hopefully it's my gift to you today. I'll save you about 8 years of suffering. Okay, questions? All right, we are ready to move on to chapter 3.